Welcome to the Business Samurai Podcast. I'm your host, John Barker. We have a returning champion today, Bojan Simic. He is the CEO of HYPR, HYPR, no E in it, whose mission is to rid the world of passwords. They have a phishing-proof multi-factor authentication program. They have raised over $70 million of revenue from companies such as Comcast, MasterCard, and Samsung, to name a few. Bojan also serves as HYPR's delegate to the FIDO, the Fast Identity Online Alliance Board of Directors, and again, whose whole mission is to get rid of the world of passwords. And they just released a press release that was last week about doubling revenue over the previous year. So I want to thank Bojan for coming on and also say congratulations on the success.
Thank you. It's a pleasure to be here again, and I appreciate the congratulations. Although in the startup world, you're expected to double revenue every year. Yeah. So
hey, that's just, we keep saying that. That's always, it's always feel good. So one of the things that I think we dove into on the first one a lot about the technology, kind of your background, but I think you even kind of mentioned it, and it was kind of my feeling as well. Really, what is that process? A deeper dive in that process of going through the, as you called it, painful experience of trying to raise venture capital, because maybe there's a lot of people out there now. You see this stuff all the time. There's a guy there's a hashtag out there called We Hack Health, and it's a group of basically tech professionals in the fitness. Assisto, they just rang the bell on the New York Stock Exchange yesterday, and I was like, dude, that's like awesome. I can't remember something zero. Chris, if you hear this, don't yell at me for not remembering that. But anyway, but being able to go through that process, kind of what your end vision is looking to as you grow, and I wanted to have that more in-depth conversation. So to kind of kick that off, how did when you came up with I've got a better tool, I got a better solution to get rid of passwords, and we want to really try to drive this forward. I mean, is this like a couple guys in a garage scenario like the Google startup? I mean, kind of where was that? How did that begin?
Yeah, it was kind of like that, except we were in New York City and we met at a Bitcoin meetup. But yeah, it's very similar. But yeah, look, it all starts out with just an idea or talking about a problem statement. Hey, there's this problem. Ours was, gee, there's a lot of fraud happening out there, and if you look at the least common denominator, it's because of the way that people are authenticating to things. And so from that point on out, you just get a few reasonably intelligent people in the room, but ones that are very stubborn as well, and don't like to give up on things, no matter how bleak an outlook might be. And then you start to build technology, and you take it step by step. And eventually, you need more and more capital to keep growing the business. And that's when you go out and you put your hands out to venture capital investors. And, hopefully some of them take a bet on you.
So with you guys, what did you have a baseline of like a minimum viable product, an MVP that you guys got functioning first? Did you have like some market test, a couple of small clients that you were trying to prove the concept before you started getting to that area of going, hey, we've taken it this far with our small team, but now we really need to ramp up? What were some of the milestones or checkpoints that you had before even starting going down the VC path?
Yeah, so there are like really 4 T's. That is what we call them in technology or in building a company when you're looking to raise capital. The 4 T's are technology, right? Is the tech good? The second one is traction. What traction do you have with your technology and with your product? The third one is timing. Is the thing that you have going to make an impact? Is it going to be a viable business in the immediate to short term? And then 4 is the team. And if you have all 4, that's phenomenal. That means you're probably not going to have a very difficult time raising venture capital.
Did you know that? Did you know those 4 T's when you started, or did you learn that? Or was that a learning?
I learned all of those the hard way.
Because that sounded very polished and like you've done that before, and I'm like, hold on a second. Did you know that going into this?
No, actually, and when we first started, we didn't have any of those. So, myself and my co-founders, we're first-time founders, and right. So that immediately takes the team part out of it completely. not only are we first-time founders, but we also have never really built anything historically of consequence. You know, you got a lot of people right now that raise venture capital because they were employee 120 at Google or whatever, you know, and they go out and raise money, and that's why you see all these people on LinkedIn with like ex Google, ex Facebook, ex whatever, as part of their fundraising strategy. We didn't have any of that, so the team thing was just completely shot. Timing, it was debatable. You know, we were going to people and saying like, you need to get rid of passwords, while everybody's like, yeah, passwords are terrible, I don't like passwords, is the timing right for adoption in the immediate term? So that was very much debatable whether or not we had that. And I'll tell you right now, at that time, this is circa 2015, we did not have it. So we had to look at traction and technology. And so we went out and we built an MVP. And we talked to some potential customers about it. We polished it, and then we basically came to the understanding that if we want to raise any venture capital money whatsoever, we had to get traction with the technology that we had built. And so it wasn't until we did that in a meaningful way that we actually were able to secure funding. There are many people today that are able to get funding without any sort of MVP or product. True. But it's because they have the team and the timing pieces much more fleshed out.
Did you go into the process of going, hey, we've got this idea, we want to build this solution set, this is the problem we're trying to solve. Did you go into it knowing at some point we're going to have to raise money to really get this where we're going? Or was that kind of, you kind of went so far and you're like, oh, wow, we need help?
No, we knew that we were going to need capital, and a fair amount of it. None of us are, independently wealthy to the point where we can just not have a paycheck for years and years to try to bootstrap a business. So for us, we always knew that we needed capital. So it was always a race against the clock of like, okay, when are our families and loved ones going to get sick and tired of us draining through our savings account and not paying the bills? To the point where we have to pull the parachute and possibly get a real job. So it's that was always the balance, and it's not always the easiest conversation to have with people who depend on you.
Sure. So you go through the process, you got your MVP, you're getting some traction, you're getting some good feedback. At the point that you said, okay, we think we're good enough to go out there and start doing some outreach, what did that prep work look like when you thought you kind of reached that baseline?
Well, in those early days, and this was our first time doing it, you just Google it, like, what do I do? and people's blog posts come up and all that type of stuff. And, first thing you do is you put together a pitch deck, right? And in that pitch deck, you should have plenty of market data. You should have plenty of research. We had some of that. Some of it we did not. And really, like, we didn't pick any particular point in time. We just started sending out feelers, crafting different messaging that we thought might resonate with potential investors. And look, these investors, they love talking to founders. They love talking to startups. It's literally their job, right? So any one of them will typically take a meeting with you if what you have is compelling enough and the market is potentially big enough. But that's the easiest part of it.
One of the things that, and I wish I could find it, I read a book on venture capital probably 10 years ago, and I couldn't find it again. I lost it to time. One of the things that I kind of remember reading is that there was a balance between the idea, but also the kind of the founding teams, their personality and kind of their drive. Did you find some of that in the early phases where people were trying to fill you out as a person as much as the business idea that was kind of behind there, to see if you had the drive, the chops, or whatever those intangible characteristics are?
Yeah, like, look, that's critical because I mentioned the 4 T's. The team is probably the most important one by far. And so that's why a lot of times, you see people raising venture capital with a good team without any sort of product or anything else. It is very rare that a group of people will, or a set of founders will raise capital without a good team. They have to have just overwhelming traction. Like we had to have a fairly significant amount of revenue with marquee customers before we were able to raise venture capital, because we did not have, we were not able to check the team checkbox because we just weren't proven enough. And if you're an investor, a venture capital investor, you're looking to invest in a group of people that you think will ultimately grow the business 10, 100 times from what it is today. And that just requires experience.
So, and I guess going through those, I remember you saying, I believe it was you were rejected 78 times.
Yeah.
During that process. What, and I remember we kind of briefly touched on it, but when you would do your pitch, were you getting feedback of going, hey, you're missing this? Or were they kind of keeping their cards close to the chest for whatever reason, but for you to be able to iterate your presentation next time, or go fill those gaps that you were missing, whether it was in the team or you needed more marquee clients or something like that, were you getting actionable feedback from that process?
Yeah, some of them will give you very good feedback. Like the investors that really take the time to understand what you're trying to solve, they will give you really good feedback, even if they choose not to invest in that point in time. But a lot of them will just say, I don't think the timing is right for this type of solution. Let's talk again next year. That's a very typical response. Or my favorite is, let's stay in touch. We'll see how your quarter finishes, and then maybe we'll have another conversation. So the thing is, it is very rare for an investor to just tell you absolutely no.
Okay.
Because they want to, keep their options open with you at all times. But most of them will say, okay, not right now, or let's talk later, and so on and so forth. And frankly, that's okay, because the founder-investor relationship is not one that just comes out of nowhere. A lot of the investors that we work with today, and the ones we worked with in the beginning, we had pitched them 3 or 4 times. We had known them for a year plus by that point. So they had seen us pitch to them, give us feedback, us reiterate our approach, improve our pitch, improve our product, get more traction, come back to them and say, like, look, we still haven't given up. We still believe in this. These are the improvements that we made. Look at it. And only then were we able to actually get investment. So all the investors that gave us funding in our first funding round, we had known already for quite some time, and had pitched them multiple times and had been turned down multiple times by them.
So yeah, okay. So when you're talking about the number of rejections you went through before you finally got that first hit, that may have been it may have been the same one that have said not yet, not yet, not yet. Oh, okay, now we're ready.
No, that was 78. That was 78 different investors.
Oh, okay. That's what I was getting to. I'm like, or was that truly 78? So it was probably a lot more than.
Yes. Yeah.
So how hard is that? I mean, where you think every time you're near, do you all right, we got it this time, and to keep it. I mean, how do you because there's that mental thing there. How do you know to keep pushing through that?
It can be heartbreaking, especially like once you get to the point where you get through that initial meeting, and then you get to the broader partner meetings, and then you're presenting to an entire group of investors that work at that firm, and then you think the pitch went extremely well, and then it still doesn't happen. Like those are the worst ones. But it's just about being resilient. It's about having conviction in what you're doing, and sticking to it for as long as you possibly can. There are many, many great ideas out there, many great products out there, many great MVPs that have been built that just didn't have the right founders in place who are willing to stick it out to take the company to the next level. And sometimes that's really all it takes.
So what was the process like when you were told, yeah, we're going to stroke you a check?
Was like, okay, how much? And then It was about, well, this is where all the paperwork comes into play, right? Because at this point, you're a small company, handful of people. You have to get all your legal stuff in place, right? You have to
I was going to ask about that.
get
Yep.
your company's valuation. You have to incorporate the proper way, right? Are you a Delaware corp? All that stuff, right? Um, so all of the paperwork stuff happens, all the background checks happen, everything else, and then you start walking or slowly jogging on the venture capital treadmill, and there is no getting off once you're on it.
Okay, well, elaborate. What do you mean by the venture capital treadmill?
So typically, what you do is when you go to raise venture capital, like you have a discussion with your investor, who is your partner now. So any investor that chooses to go to their committee and say, I believe in this company, I believe in these founders, we need to invest in them, they're kind of putting their neck on the line a bit as well. So you're really partnering with the investor, and it's very important to have a great relationship there. So what you do is you talk about how much money you need, how much money they're willing to invest, and then you come up with a budget about what you're going to do with that money, what you're going to spend it on, and in what period of time. And so typically you will come up with a 2-year budget.
2 years.
Means
Okay.
you get a chunk of money, and you need to come up with a 2-year budget of what you're going to do with that money, to spend that money over a 2-year period. Because investors have to recognize value for their investment at some point in time. So it's not like they're getting any residual income or revenue or anything based on their investment. They don't actually recognize value, or they don't actually cash out anything unless your business is acquired or you go public, right? So they're just sitting there in limbo, more or less. So you really have to come up with a 2-year budget typically to spend that money, and hopefully within those 2 years you've spent that money appropriately to the point where you've gotten more proof points in those 4 T's to get another venture capital funding round.
Okay, so that's when you go from, what do they call it? Round A, round B, round
Yeah.
C, or something. Okay, now when you get this, are you looking for more than just the capital resources? Are they bringing part of their network into this? Are they bringing additional management oversight because they've had resources that have been there, done that, type of thing? Are they bringing that to the table as well to help accelerate, your ramp?
Yeah, a lot of investors have taken, so traditionally venture capital investors decades ago, they provided primarily capital. But in the last 20 years or so, primarily in the last 10 years, really, venture capital investors have really started to build out additional value adds that they provide to their portfolio companies. So, like, some of our investors have been just amazing in helping us recruit, like helping us get really good senior people to help take the company to the next level. Other investors have been better at making introductions to potential customers, while others have been really good at helping us get our stuff together with regards to our back office processes. How do you, like, you're a small company, you just raised some capital, you don't have money to hire a full-time lawyer team, right? So they will lend you their attorneys, or they will, provide you with paperwork and templates for meeting certain regulatory requirements, or things like that. Stuff that you, as a founder coming from maybe a technical background, know nothing about, but they're ready to help you with a lot of those things that you may not have no idea. Like, how do you do payroll? I don't know. Like, if you ask me today, I have no idea. But like when we got our first investors, like, they helped us with that.
Gotcha. Now, does it make the subsequent rounds then, as you continue to bump up your 4 T's, you're getting more higher quality clients? You can sit there and go, hey, look who's invested in us now. Did that make the subsequent rounds much easier then, or did you still face some resistance in that process?
It can be much easier depending on how well your business is doing. So we've done 4 rounds of venture capital now.
Four.
There
Okay.
there have been there have been rounds that were far easier, and there have been rounds that have been pretty difficult, right? Just depending on how well you're doing in those different areas. Um, and it also really just all depends on the investor too. Sometimes um, you'll have investors who are bolder in their thinking, who believe in the big vision of the company, and they're like not not so they don't care so much about the nitty gritty details as much. They all care about them, but some don't care about them as much. Whereas you'll have more conservative investors, where they're like they just look at the Excel spreadsheet, and if the numbers
Mhm.
don't make sense, they're not going to be able to move forward. And so it's about finding a balance, because sometimes if you just have pie in the sky type of investors, then everything's rosy all the time until it really isn't. And then they tend to kind of um, behave differently at that point.
Did did was there any reshaping when you finally get this? You start getting the advisement from your investors, reshaping the business model or tweaking a little bit of what you were aiming for, target demographics or things of that nature. That from where your initial path was, where you had to kind of you took a sidestep to go forward in a different path at all, or were you able to maintain kind of the initial your original vision before you went the venture capital route?
Yeah, it evolves, right? And your investors will help you ultimately on figuring out the right go-to-market strategy, if that's what they know how to do. And typically investors, like with venture capital investors, a lot of people think that like you get a venture capital investors, they come in and they just tell you what to do. That hasn't been our experience whatsoever. Our investors have always just come in and said, okay, guys, this is what our portfolio companies that are outperforming significantly have in common. And here it is. Take advantage of it if you want to, but we're not going to tell you what to do,
Gotcha.
right? Um, so for them, they won't tell you to do anything in particular, but they will provide the guidance. It's about how you take that guidance. Sometimes, if you're a first-time founder like myself, you kind of have a bit of an imposter syndrome at all times, where you're sitting in a room where, like, it's my first time being on a company board, right? The person I'm sitting across from is on the board of 10 companies and has been doing this for 25 years. Like, what the hell do I know? So it can be a bit of an imposter syndrome. But the fact is, you just have to understand that they will never understand your business the way you do. So, not that you should take the things that they say or advise with a grain of salt, but just take it as input into making your business better. Um, and they completely understand that. So yes, our approach has changed in some regards, but the core value of our product and our business still is the same.
That you're going for. Just a brief snippet because I've never shared this with you before. I was 22. I was part of a startup that received a 8-figure investment after I'd been there for a year and a half, and we knew that was the part of the goal. And some stuff was not shared with us, and I had ran entire network operations at this point at this place. And no kidding, we went from Tuesday it was one way, and Wednesday there was like an army of new people that just showed up and like blew the place apart from where it had been before. And that had just been my own single experience again, almost 20 years ago at this point. And I didn't know if that was kind of across the board or how that kind of functioned, or if it was kind of here's your thing, we're going to be your advisors and try to help you, because obviously they want a return on their investment at some point, some future point down the road. How often do you have to, now that you sit there, you've got this new partner involved, how often do you meet to have to say, here's the checkpoints that we're going on, milestone updates, or like quarterly meetings or annual, I don't know.
Yeah, so we have like quarterly board meetings with everybody. And then, but I will have, as a CEO, I'll have touch points with certain board members, some biweekly, others monthly, just to make sure that we stay aligned and we're on the same page. Because the thing that everybody hates is surprises, right?
Yeah,
So
right.
you never want to show up to a board meeting and like you know, you unveil something on a slide and people are like, "Whoa, why didn't you tell me this, 2 months ago? I could have helped you with it." So staying on the same page with investors is critical, but at the same time, kind of understanding, when it's too much, because a lot of them truly do want to be helpful, but sometimes they can be too helpful, right? And so finding that balance with each investor is different. So I have, investors that I talk about the details when we get on a call all the time, and then I have investors where we talk about more abstract topics. It's just about knowing who can help with what and when, and how to leverage that relationship.
Well, you just brought something and just hit me. You went through different rounds, so you got a ton of different investors in there. Are you meeting with these guys, each one individually, or do you do this in like a group, or is there like a group setting where everybody that has kind of a piece sits at the table with that?
So at the board meetings, everybody comes. And so typically, when you have a company board, you have board directors and you have board observers. So not every investor is a board director, and so really the observers have an ability to come to the board meetings, ask questions, be part of the conversation. But when it comes to like voting on certain things, the directors are the ones who do that. And so I tend to have regular touch points with all of my directors, and with my observers, they're less frequent.
With the way that and I don't want to, I'm gonna preface this with, I don't want you to obviously disclose anything that you feel is like a internal company secret type stuff, so we can keep it generic if you want. But what are you've went through this process now, you went through 4 rounds. What are the return on investment expectations, like time frame? Stuff I've read is, most places are looking for a 10x return because they know not everything is going to be a hit when they're venture capital. So they got to make up for those ones that don't. But what, you're having those pitch meetings, you finally get it. Do you have expectations of, hey guys, we like what you've got going on. We expect you to either be acquired or go public IPO within a decade or 5 years or something like that? I mean, do they start putting the parameters around that get adjusted as you see how the market takes shape?
So your investors will never, at least from my experience, they'll never tell you like what you should do. But the expectation for them is to have a event within 5 to 10 years. And depending on when they invested and how much they invested, that their expected return will be different. Right. And so really, I've never really had the conversation with any of our investors around exactly what timeline they have an expectation. They understand that we're growing a business, and every single year we need to be making meaningful progress. Like and if that happens, then the outcome that everybody wants will occur. So like typically, yes, investors do want a 10x return, of course. A lot of them are happy with a 3 to 5x. Again, depending on how long they have had that capital committed. If you invest in something today and then a year later you get a 3 to 5x return, that's damn good. But if you invest something today and then 7 years later you get a 10x return, that's really good. You're equally happy in that regard, right? So, and then there's companies that become companies of consequence, right? Where an investor can say, "I was the first investor in that company," and gotcha. So, like the guy that first invested in Google, right? Like,
right,
because those types of reputational investments improve your standing within the entrepreneur community, because the venture capital landscape is very competitive. Like, these guys compete with each other all the time on deals, and that reputation is really important to them.
I knew employee number 30 at AOL pre-IPO. He retired at 32. So that's my claim to fame from 20 years ago. Obviously, is AOL around anymore? Do you guys have, the product that you have with HYPR can be considered very niche in the cybersecurity space? Is part of your growth strategy, and again, feel free to disregard the question, but to acquire other technologies to make it more encompassing other areas, or or is it just continuing to expand your the product in its current state?
Yeah, I think
The client base in its current.
Yeah, our
state,
primary strategy is to kill the password right now, right? So when I think that some people would consider it niche in the security space, absolutely. But when we think about the companies that come to mind when you think about a startup or a successful tech company in your mind, right? What are the companies you think of, right? I think of like Google, right? I think of like Facebook. I think of Apple, right? I think of stuff like those are the companies that everybody knows. I even think about, places like AOL, right? To some extent, like that was all over the place, in the 90s. But like when you think about businesses and their applicability at internet scale, so let's just think about some things that every single person on the internet has in common. Well, we all use a browser. Thank you, Chrome, or whatever you're using, right? Google. We all use a search engine, typically, right? Google. Pretty much everybody has some sort of social media, like an Instagram or a Facebook.
Yep.
But even more prevalent than any of those is like every single person on the internet has a password. Not just one, they have hundreds. So when we think about the scale of the problem and the opportunity size overall, it is huge.
It's absolutely
right. Like
huge.
we're sitting here we sit here and often talk about like, oh, companies need MFA, blah 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 blah. Yes, they do. And that's the thing that's really critical today because it's all over the news and Lapsus just hacked this company and that company. But like when we think about the actual scale of what our business is accomplishing, it's massive, right? And so if we're successful at that over the next 2, 3, 10 years, like there is a reality in which we're sitting here in 10 years talking about HYPR in the same way that we are talking about Google or Facebook or those, right? If that is the outcome.
For me to log into us to do this podcast, I had to sign into 3 different things and use 2 different MFA tools because of the way they were linked.
Exactly. Yeah.
And that was just to record this podcast. So going in. No, and that's awesome because the problem is gigantic, and I'm glad to see that there is other people that in an investment, whether they had a tech background or not. I don't obviously with someone like Comcast or I'm sure MasterCard, the ones that I mentioned at the beginning understand that from a technical perspective. How was your expectations going into the process? How did it meet the reality of what you went through, from your standpoint?
So when we first started, we had an MVP and we spent a lot of money on a conference booth or on a booth at a conference. And we showed up and we crushed it, dude. Like we were
awesome.
Like it was amazing. Like we spent a bunch of money on a booth. We had so much interest in our product. Like we were, I think, the number 5 best product in ZDNet that week. Like we were between Facebook, which was Oculus, and LG.
Okay.
Like in between them was HYPR. And we were like an 8-person company at the time or something. And we were like, wow, the venture capital money is just going to come pouring in now. And we had a bunch of investors come to our booth, talk to us, take our information, follow up with us after the conference. And we found ourselves in this position where, like, after this conference, we had like just a calendar full of meeting invites with investors. And then we started pitching all of them, and they very quickly realized that, we didn't have the team, the traction, the timing for the technology. And so reality smacked us in the face really hard, and we had to go and really fight and build in order to get the eventual outcome that we wanted.
I never, I never hit me to ask this in the beginning. How long was the time period from your first pitch to an investor till you got that first yes? Are you talking, was that like a year's thing? Like 6?
It was like 18 months.
Okay.
Yeah, which was about.
Was that 18 months
15
longer
months
than you thought?
longer than we thought.
Okay. I was close.
Yeah. So the thing about venture capital is it always takes twice as long as you think it will.
And then how long, you talked about, and this is that we're having a circular conversation then. You get your yes. So how long is the process from yes till you see that you can execute on funds in the account based on the budget that you created? Is that like a lengthy process as well? Or is that like...
It's a few weeks. Yeah.
Okay. Like, that's why, I didn't know how long
short.
the legal process comes in there. And when somebody says that, I imagine I didn't know if this is like a Shark Tank thing and Mark Cuban says, here's the check. And right there, see the lawyers off screen.
No, and like, it's not like Shark Tank whatsoever. And so maybe that's part of the reason we were so naive in our approach, because we all watched Shark Tank too. But yeah, like, look, in venture capital and in technology in particular, sales is or businesses are expected to have, very fast growth, and that's, investors want to invest in high growth companies. Otherwise, they would just say, if you want to have a business that grows incrementally and you want to, take your time with it, just go to a bank and get a loan. That's the alternative.
Gotcha. So I'll get you to summarize a little bit of what we've talked about. For anybody that's sitting there, they've got their idea, they're sitting at their home in their basement doing this. What would you say are like the top 5 do's and don'ts prior to going out there to be successful and minimize the rejections of looking for outside capital?
Top 5 do's and don'ts.
Or how many ever, yeah.
Okay, yeah. So one, so do's for me are, make sure you have a team that you can trust and is in it to win it for the long term. Because as I mentioned earlier, you'll need, a lot of these investors, you'll meet them several times, and you want to make sure you're meeting with them with the same group of people. 2 is obsess over talking to your customers or your potential customers. Sharing their stories and being able to articulate how you're solving these problems for them is the most important thing. 3, bring as much objective data as you possibly can into any meeting, right? So market analysis, trends, research, numbers, reports, stats, all of this stuff is really, really important to build credibility with your potential audience. 4, practice the pitch and presenting, and just be extremely confident in your approach. Because an investor will say, well, I don't think this will work, just to your face. And you have to be bold and confident and say, yes, it will work, and this is exactly why. Even if they are a multi-billionaire who has backed 50 companies. Right? One of my favorite things just on the internet is, I think it's Bessemer's anti-portfolio, where on their website they have a list of companies that they have turned down previously, and exactly what they told to the founders in their rejection letter. And they have like Google and Facebook and like all this stuff on there of when they rejected them and why they rejected them, which is really, really interesting to see. Um, and then I guess 5 would be, I guess I should do a don't. Um, don't assume that what you're doing is a great fit for every investor that you see. Some investors are just not the right fit for your space. Some investors are just not the right fit for your culture. Like myself and my co-founders, we live in New York City. We behave a certain way. We have a certain attitude and certain way that we approach things. It is not too similar. It is not very similar to the way that people do things on the West Coast, which is why today most of our investors are on the East Coast for that reason. And so it's just a somewhat of a cultural and cultural difference as well. So it's about finding the right fit, not just from a partnership perspective on the money side, but also on just the relationship side. That's really, really critical.
Are you meeting with the people that are actually technically competent from somebody's investor's team that understands exactly the problem you're solving, or is this more of a business type person that gets it theoretically?
So if the business type person gets it, then they will typically invite experts that are either advisors to them or work with them directly to vet what you're saying from try to poke holes in your technology, basically.
I was wondering, yeah, what's the thing, if you can explain it to a 5-year-old or something like that?
Yeah, like they're also trying to understand, like, how easy is this thing to reproduce, right? If I invest in it, are there going to be 10 people who are doing it tomorrow with little to zero effort?
You mean like on Amazon? Well, awesome. I appreciate the time and the deeper dive in this. I think there's a lot of people that find that fascinating because you see the stuff all the time, in the news that, hey, this company, they're going through multiple rounds, or again, like the company I saw that, I don't really know him, but I'm aware of, that went IPO yesterday, or rang the bell. They were actually on the New York Stock Exchange and rang the bell. And it's like, what are those early phases to start getting you on that path where the next thing I know, I'm going to see you on the New York Stock Exchange, ringing the bell, or NASDAQ, or whatever the path is. And I'm going to go, hold up, I know him.
Yeah, I'm looking forward to that day. Yeah.
No, that'd be awesome. Best place to still reach out for you is LinkedIn?
Yeah, absolutely. I'm on there. Sometimes too much, but yes.
I'm guilty of that as well. Again, appreciate the time. This has been awesome, and I'll make sure to have all the links in the show notes for everyone.
Thank you, John. Pleasure.